investor confidence in tax reform has grown significantly, and that growth has been reflected in somewhat of a rotation in what has appreciated more over the quarter. Secondly, there's been a global improvement in earnings. There's what the term has been is synchronized global growth, and the evidence of synchronized global growth has really picked up over this quarter, and that has also caused some dispersion in what has outperformed others. And finally, investor confidence in actually a rate hike in December has reached almost near certainty levels, and that has also impacted performance. So let's look at the chart first of the S&P 500. As we can see, this has just been virtually a straight line up all quarter, and that has continued since the end of the quarter as well. From this chart, it looks like really nothing has changed, but some things have subtly changed, as I mentioned, and we'll go through that in a moment. Next, we're looking at valuations, and valuations are pretty hefty right now. As we all know, valuations are stretched, but they can become more stretched. On the left is really your basic forward PE, and we are higher than normal, but not so extreme that we're beyond a 2 standard deviation measure. So we are higher than normal, as I said, but we're certainly higher in the 2000 period. And valuations can, as we said, remain high for quite some time. Now on the right is a price to sales, which shows an extremely overvalued market, frankly, approaching 2000 levels. I would give one caveat to that, which is the structure of our market has changed. With technology taking over, you'll have some natural higher ratio in price to sales because margins are so much greater in technology than they are in, for example, manufacturing. But nonetheless, this is a very high valuation. On the other hand, however, earnings have been improving. And this is a chart, and the black lines show historical earnings, and the green line shows projected earnings. And we see that we really have come out of what we had in late 2015 as an earnings recession. We really have come out of that earnings recession, and we are really moving positively. And this is in part what's driving the optimism in the market. As you can see, the projections for increased S&P earnings per share continue to be higher. And so far, the results this quarter, and if you followed what's happened with Microsoft and Google and Amazon today, they've shown excellent quarter results, and the results seem to be justifying this optimism. Now, when I mentioned the slight reversals of what has occurred, and it's not really reversals, it's what has outperformed others, we see the tax-sensitive stocks, the red line, the white line, is outperforming. And the tax-sensitive stocks have been outperforming in large part because of renewed optimism that a tax package will pass. The other thing that's occurred is that the growth versus value spread has narrowed. Now, if you'll look back in this chart to November when the election occurred, you'll see that value dramatically outperformed growth, and it outperformed growth in large part because of what's been known as the Trump agenda, the thought that there would be deregulation and tax reform, both which would benefit things like financials, which are all value stocks. So there was really optimism about what happened with the value stocks based on tax reform and based on deregulation. As healthcare reform did not prove to be successful, at least as of yet, the confidence in the Trump agenda decreased, and then you saw growth significantly outperform value. Recently, as this optimism in tax reform has changed, you've begun to see value rally in relation to growth. One of the things that we keep our eye on at Coldstream is volatility. And volatility in the markets is exceptionally low right now by historical standards. The right-hand chart shows you the maximum drawdown of the S&P 500 for each year, and you can see we're really at historical lows for a drawdown. And the first chart shows the number of days of the S&P that's had 2% moves, and for the first time since 2000, 2005, excuse me, we have not had a 2% move in the market to date. Exceptionally low volatility. This is a yellow light. It shows investor complacency, and investor complacency can turn on a dime. The low volatility does not only relate to equities, it also relates to other asset classes. Now what we have here is currency volatility, but this applies as well, and even more so, to bond volatility. Now I realize in the last couple of days, those who follow the bond market will see that bond volatility has picked up as the certainty of a Fed increase has come into the markets. But nonetheless, the MOVE index, which is the measure of bond volatility, is at historical lows as well. As we talked about the confidence in the Trump agenda and the tax reform, this very much benefits small and mid-cap stocks focused in the U.S. In addition, there's been saber rattling regarding trade, and that saber rattling regarding trade also helps domestic stocks. And the Russell 2000, which is small and mid-cap stocks, which are really domestically oriented, have significantly rallied, and you can see they've rallied from the middle of the quarter, not at the beginning of the quarter, right at the time when confidence in tax reform became prevalent. The all-world U.S. index continues to rally, straight line up this year. It's been an excellent performer, and emerging markets have continued to really lead the way. There's been a bit of a fall off recently, but in the last few days they have returned, and they have been the best performing equity index. I've mentioned synchronized global growth, and this chart may appear a bit busy, so let me explain it for a minute. This is the Purchase Manufacturing Index, and above 50 in the Purchase Manufacturing Index is bullish. And if you look at September, throughout the world, even including Brazil, which was in a significant recession, is above 50 in the Purchase Manufacturing Index. We are really seeing some synchronized global growth, and that is the fundamental cause of the equity markets rallying. The dollar has turned recently positive. It has been certainly still negative year to date, but this is really a sign of the optimism about, well, optimism isn't the correct word, but the thoughts that the Fed will raise rates in December and that interest rates actually will go higher, which strengthens the dollar, and we've seen that turn around recently. Also, confidence that the Fed will raise rates is reflected in the yield curve, and the yield curve really measures treasuries from 1 month period to 30-year period in terms of what their yield is. The green line is where we were a year ago. The blue line is where we are today. We can see that we are higher in the short end, but lower in the long end. Lower in the long end means somewhat a little bit more subdued prospects for inflation and growth over the long run, as confidence that interest rates actually will rise in the short run rate increases. The conundrum, of course, for the Fed has been, as we all know, that inflation has remained stubbornly low. There are some signs over the last couple of weeks that there may be some green shoots in inflation picking up, but still the numbers are pretty stark. The blue line is headline CPI. The black line is core CPI, and we can see that they are below their, well below their 50-year average. Below the line is the PCE deflator. It's a different measure of inflation. It's the measure of inflation that the Fed relies on, and they have a 2% target. It's still well below the 2% target, which is the subject of the debate as to whether the Fed should actually raise or not, given inflation is not near its 2% target. Yellen certainly believes that these non-improvements in inflation are transitory, and that there are signs that the economy is heating up, which is sparking her view that rates need to be raised. One interesting thing, however, to look at is that inflation has consistently undershot the Fed's projections. The black line on this chart is what actually has occurred in inflation. The colored lines are at various times the Fed's prediction in the future of what inflation will be, and we can see that almost consistently the Fed has been overly optimistic about inflation. Quickly, to wrap up, rates throughout the world have remained low, not only in the U.S. These are historical numbers dating back to 1800, and we are well below the historical median and below any other time in history. Short rates still remain negative in Germany, still remain negative in Japan. Despite our concerns about valuation being frothy, we do not see a bear market in sight. We do not see an recession in sight. LEIs, the leading economic indicators, and what those are listed on the left, and the coincident economic indicators. The leading economic indicators are at the best that we know of prediction of inflation coming in the next 6 months or so, and they are still rallying. They are not turning over, and the coincident indicators are as well. So we are not saying that there may not be a pullback, but we are certainly saying we are not seeing any signs of a recession in the near or shorter intermediate term. Finally, what's the conundrum? What's the elephant in the room? What is the thing that we really need to keep our eye on? And I think it is more than anything, will the Fed be able to pull off the reduction in their balance sheet seamlessly? This is an historical experiment. This has never happened before, where the Fed has accumulated the kind of balance sheet they had before and have to reduce it. The plan seems to make sense, a very gradual reduction over time, but since it is something that's been tested, it's something we're keeping a close eye on in terms of its impact on markets. That concludes my part of the presentation. I'll turn it over to James to talk about reinsurance.
Thank you, Howard. So my portion of today's call is in regards to the reinsurance market. And it's been a very active year in the insurance market, as we've had many natural disasters strike the United States. Before I get started, though, I wanted to quickly recap the kinds of reinsurance that we invest in. There's a bit of an alphabet soup and acronyms behind these structures, and so I thought I'd cover that quickly. The two areas that we invest in are what are called catastrophe bonds and quota shares. Catastrophe bonds are generally 1 to 2 years in duration and cover severe but rare events. They're typically for low probability but high severe events, and they cover what we call the 4 peak perils, but there's also hundreds of other global exposures available in the market. Those 4 peak perils are Florida storm, meaning hurricanes that hit Florida, East Coast storm, hurricanes that might hit South Carolina, North Carolina, and up to New York, California earthquake, and Japanese earthquake. The other area that we invest in are what are called quota shares. These are issued by reinsurance companies. Maybe you've heard of some of them. Munich Re and Swiss Re are some of the largest in the world. Berkshire Hathaway is also another large reinsurer. In a quota share, an investor purchases a portion of a reinsurance book. You're looking at their entire book of business and taking down a portion of each of those reinsurance contracts, which could cover hundreds of different risk exposures across the globe. Their terms can be between 1 and 2 years. And there's liquidity basically annually. In quota shares, the returns tend to be a bit higher because there's embedded leverage. In a quota share, a reinsurance company is typically issuing more insurance than they have collateral for, and that overcoverage is a way of achieving leverage in the portfolio. In a cat bond space, the cat bonds are fully collateralized, and the maximum loss is the amount of the coverage itself. The big plus on the quota share side, though, is it's even more broadly diversified across loss exposure. You have lots of things in there, maritime risks, airplanes, crop damage, all kinds of different risks that aren't really represented in the cat bond space. So this year has been a very active year. We've had 4 major hurricanes make landfall. Harvey hit Houston, Irma hit western Florida, we had Maria, which impacted Puerto Rico, and Nate. And listed on this slide, you can see the estimated losses, and these are currently estimated losses. We don't actually know at this time what total the losses will be. It'll be a few months before all the claims come in, but you can see each of these hurricanes had significant impact. Harvey did about 10 billion of estimated insured losses. Irma was 25, and Maria, which we still don't know. There's a big range here. We've got 40 to 85 billion listed there, and that is from the group called AIR. They do catastrophe modeling. A competing firm that also does catastrophe modeling, RMS, has the damage levels at much lower numbers, approximately 25 to 35 billion dollars. And that's due to the type of losses. Most of the insured assets in Puerto Rico are in the central portion of the island. The central portion of the island did not take as much damage as the coastal portions. And it's really a matter of getting claims adjusters out to Puerto Rico to assess the damage and pay out claims before we'll know. But there's a big range there. It's anywhere between 25 to 85 billion. And Nate was a smaller storm, 500 million to 1 billion. Also this year we had 2 large earthquakes in Mexico. The most recent being in Mexico City. That looks to be a 800 million to 1.2 billion or 1.9 billion in damages. And then also there was an earthquake in the region of Chiapas, where insured losses are 730 million to 1 billion. And also most recently, and making the most headlines most recently, is the cluster of fires that we saw in California. And there's a large number of fires, 4 of which were in Napa County, or excuse me, 3 of which were in Napa County. The total insured losses for this cluster of fires looks to be about $1 billion. So if you look at 2017, it looks like $100 billion a year. And so I'll put that in context in the next slide. The chart that you see is the total historical return of the Swiss Re Catastrophe Bond Index. So this is an index that tracks all the cat bonds in existence. And this chart implies an investment in each of those pro rata relative to their market share. And over time, the annualized rate of return on this index is about 7.3%, a total return of 201% between the period of January 2002, when the index was incepted, through September 30 of this year. You'll see there are a number of dips in this chart, and those correspond to other major natural disasters. In 2005, we had Katrina, Wilma, and Rita. Those total combined insured losses was about 117 billion, so similar to what we experienced this year, maybe a little bit larger in magnitude. In 2008, there was a dip in there. Some of these cat bonds were non-collateralized, and they did not have escrow, and they were obligations of Lehman Brothers, and so some of those went away during the bankruptcies. From the financial crisis on, catastrophe bonds are all escrowed with treasuries. They are backed by treasury bonds, and so the credit risk exposure is gone. But the other significant events, in 2011 we had Japan and New Zealand both experienced large earthquakes. There's 105 billion losses there, again, similar to what we saw this year. And Superstorm Sandy itself caused about 77 billion in insured losses in 2012. What I will point out is that despite these $100 billion loss years, those years were positive in terms of premiums collected versus claims paid out, which is the whole point of the insurance industry. You collect more in premium than you pay out in claims. Okay? The other benefit, one of the reasons that we like reinsurance as an investment asset is its non-correlation with other traditional assets. As investors, you can invest primarily in just a few things. You can buy cash, you can buy bonds, and you can buy stocks. Other assets that don't behave like that might give you a rebalancing opportunity, because stocks and bonds and cash don't necessarily always work very well. Cash sometimes pays zero. Bonds, as interest rates go up, can lose their value, and the stock market can obviously go down too. And so the idea is to add in assets that don't behave like those other assets, or even counter to those other assets as a hedge, and gives you the rebalancing opportunity to say, if the stock market were to sell off, reinsurance does well, you would sell your reinsurance and buy the stock market on the cheap. What you're looking at in this scatter plot is the weekly returns of the Barclays Aggregate Bond Index relative to the Swiss Re Global Cat Bond Index. And what you're looking for is that red line in the center. The flatter that line is, the less correlated these two assets are. A perfectly correlated asset, that red line would look like a 45-degree angle, meaning every time bonds work, reinsurance works, and every time bonds don't work, reinsurance doesn't work. Well, the fact is they're not correlated to each other whatsoever. This is graphically represented on the bottom portion of the screen, where in white, the little thin white line is the Swiss Re Total Return Index, and like behind it in orange, we have the Bond Return Index, and then in yellow, we have the S&P 500, and you can see that the behavior, the ups and downs, do not coincide with one another. these are diversifying assets that don't behave like one another, giving us, again, those rebalancing opportunities. The current funds that we invest in, we have 3 that are in client accounts at this time. We have the Stone Ridge Catastrophe Bond Fund, which is SHRIX. It invests primarily in the cat bond sector of the market, and which are, again, lower probability, high severity events. This fund would have been hit primarily if, like, Irma itself had hit Miami as a category 5 storm. That would have hit the cat bond index by and large. Whereas the Stone Ridge Interval Fund and the Pioneer ILS Interval Fund, which both invest in quota shares, are less affected by these, or they would still be affected by the major event, but we're more impacted by the types of events that we had this year. They're essentially lower in the capital stack. Smaller, more frequent events are going to hit the quota share market primarily, and not the cat bond area of the market, whereas large storms would affect all 3. But you can see cumulative returns over the past year are negative. This is one of the few areas of our investment portfolios that are actually down this year, but that is the nature of investing in this type of asset. So looking forward, our outlook, industry losses this year, we estimate to be about $100 billion that could come in. It could go higher as well. There could still be disasters before year end. But in terms of context, only 2005 and 2011 have seen larger industry losses. But the flip side of this is that because of these losses, the entire reinsurance industry is going to have to rebuild their capital stock. And the way they do that is by raising premiums. After events like in the years like this, premiums typically go up. We expect premiums in the areas affected, so think Florida and Puerto Rico. We're going to, next year, premiums for hurricane insurance and storm surge insurance is going to rise about 15 to 25%. And in areas that aren't, we'll still expect to see 5 to 10% increases in insurance premiums. If you look back historically at other years like the one we've just experienced, the returns have actually been higher. The premiums themselves have been higher. And so if you look at 2006, 2012, 2013, the returns of the cat bond index averaged 11%, whereas the long run average for the reinsurance for that cat bond index is about 7.3%. And so you can see on years post-event, premiums go up. Those premiums accrue to investors. Addressing, why quota shares have been hit, whereas cat bond indices and the cat bonds themselves have not been hit. Again, it falls down to where in the capital stack these kinds of events have hit. These types of events that we have experienced this year hit the quota shares. They don't necessarily hit the cat bond industry. And then also in follow-up on the California wildfires, we don't expect that to have a meaningful impact on the return of the funds this year. Again, the losses are small. I mean, in comparison to some of these large hurricanes that we've had this year, a $1 billion loss is not significant on the industry level, and on the diversification level that we have within the reinsurance funds. And my last slide here. This is a frequency chart of the number of landfalling hurricanes in the United States since 1880. And you'll see there is essentially no pattern. Everyone knows, well, not everyone knows, many people agree that the globe is warming and that this will lead to increase in hurricane activity. From our research and what we understand is that the relationship between warmer waters in the Atlantic and storm intensity exists. The warmer the Atlantic gets, the more intense storms we will receive. The wild card is how many of those hurricanes actually impact the United States, which is determined primarily by the weather and high pressure ridges, which are essentially random events. The frequency of hurricanes have been roughly the same if you just count total hurricanes in the Atlantic, whether they make landfall or not. That frequency has been relatively stable over this past century, but the intensity of the storms most insurance modelers are projecting to be higher. So you have more impactful storms when they do land. And the other thing that we're looking at is the intensity of insured assets on the coast that are actually at risk. There's been a lot of building on the Florida coast. There's been a lot of building all along the seaboard. When these things land, we can expect the losses to be larger simply by those two factors. But at this point, there is no statistically significant change in the rate of landfalling hurricanes in the United States. And that concludes my reinsurance update.
Thank you very much for listening to the ISG webcast. We appreciate your attendance. And if you have any additional questions, please contact your relationship manager or your portfolio manager. Thank you again.